Welcome back to Turning Hard Times to Good Times. I am your host, Jay Taylor, and I'm really pleased to have with me for the first time Ronald Stöferle. Ronald is, I guess he likes to be called Ronnie, except he says sometimes when he makes his wife unhappy, she calls him Ronald. So we'll refer to him as Ronnie. He is the managing partner and fund manager at Incrementum AG, based in the Principality of Liechtenstein. The company focuses on asset management and wealth management and is 100% owned by its partners. And Ronnie manages a fund that invests based on the principles of Austrian school economics. Hooray for Ronnie. That's what I have.
Hi, Jay. Thanks for the invitation. Thank you very much.
I'm glad you could join me. I know that you've been interviewed at the Mises Institute. Of course, I see your work in Gold We Trust. It's a must-read for anybody that believes that gold is money and that it has a place in society, whether politicians want it to be there or not. And it's going to, inevitably, the laws of nature prevail, so I believe. So I think we're going to see gold do extremely well. But it's not what I think. You're the guest. I do have to start out by asking you, Ronnie, today's gold price gladdened the hearts of many of us gold bugs. Is this just simply another head fake, or do you think we might be seeing something more sustained starting to take place?
Well, I honestly couldn't believe my eyes when I saw that gold was up more than 1%. We haven't had that in a while, and it kind of feels good. Well, I would say. Jay, we're currently preparing our big chart book on gold, like 70 pages about the current situation, also the macro situation, sentiment, technicals, and so on. And it seems that from a contrarian point of view, this is really a great setup. We're seeing that gold has basically for the first time in 20 years declined for 6 consecutive months. We haven't seen that in 20 years, and we crunched the numbers, and we came to the conclusion that after such a long losing streak, gold always rebounds significantly. So on average, we had a rebound by 15%. So that's like the shorter term technical setup. Sure. On the other hand, we're seeing from the Commitment of Traders report, we're seeing from my point of view the best setup in 17 years. While large speculators have completely abandoned their net long exposure, they are currently net short for the first time since gold prices crossed $270 more than 70 years ago. And on the other hand, the commercials, which are the so-called smart money, they, for the first time in 17 years, flipped their COMEX positioning to net long. So from my point of view, all is set. There could be an epic short squeeze in the cards. And also, of course, from a fundamental point of view, I think that gold is just the best insurance policy that you can buy for this let's say, very, very dangerous market environment.
Yeah, I have to ask you because of your very famous In Gold We Trust publication. You've got a new one coming out shortly. I have the 2017 version in front of me now. When will this new one be coming out, Ronnie, and how can people receive this report?
Well, the last edition is already out, the 2018 edition. I can send you a copy, and we can also provide a download link for your readers. It's totally for free. It is, we're seeing inflation everywhere, but also in Gold We Trust report. So actually, this is the longest study that we ever published. It's 230 pages, full of information about macro, gold, history, de-dollarization. We're featuring our long-term purchasing power comparisons, like the gold to beer chart at the Munich Oktoberfest, which is people just love that. And yeah, it's available in the extended and in a short version. And just to give you a short overview, we said so that the title or the leitmotif of the report was gold and the turning of the monetary tides. So we're seeing the tide turning when it comes to monetary policy. We are switching from a global quantitative easing to a quantitative tightening environment. Then we're seeing the second tide, which is the de-dollarization. More and more countries, Jim Rickards calls them the axis of gold. They are diversifying out of the US dollar. They are building up gold reserves. And the third tide is the technological tide that is turning with blockchain technology, where we're seeing a number of great combinations of, let's say, new technology, blockchain, and the oldest monetary technology, which is physical gold. So those are the three topics. And as I've said, we're already working on the new chart book, which is a more it's more chart driven with some comments. It's not such a heavy read, but as all our publications are for free, just Google them and you will definitely find them.
Well, you do have some impressive sponsors for your publication, I must say. The Tocqueville Fund, I know the folks at the Tocqueville Fund, Victoria Gold Corp and Endeavor Silver, the Austrian Mint, ABX, the Allocated Bullion Exchange, etc. Really some very, very strong sponsors. So I really look forward to receiving that, Ronnie. And yes, I will certainly make available to our, if you can send the links to that, make it available to our listeners and to my subscribers as well. You know, not to get theological, because that's not the place for this, but in our currency it says, "In God we trust." So I'm asking, do you think that we should now sort of figure that we'll just trust in the asset that God created rather than in the Creator?
Well, actually, this is a topic that we want to write next year about in the next In Gold We Trust report about gold in the Bible, but also in the Quran, in the Torah, and so on. And I think it is definitely no coincidence that gold is something special in every religion. That gold is treated differently on every continent, in every culture. That it's everywhere. It's something special, and I think it's just some sort of a trial and error process that took a couple of thousand years, actually. And at some point people realized, okay, gold has got the most important factors that makes it good money. And I think when it comes to our report, I think when we published the first edition in 2006, we said, ultimately everything is a trust game.
Yes.
And of course, when it comes to money, trust is especially important. Over here in Europe, we had several hyperinflations. Of course, we had Weimar Republic hyperinflation in Germany, which was basically the foundation for Adolf Hitler to become, because everybody was just suffering from this hyperinflation. People lost everything. And then this strong leader came, and everybody said, okay, it sounds reasonable what he says. So inflation and hyperinflation, I would say, is kind of in our monetary DNA in Austria, in Germany, and so on. While I think, and that's interesting, in the US, I think it's still the fear of deflation and the Great Depression. That's what drives people much more than the fear of inflation.
Yes.
And that kind of describes the different attitudes of our central banks, I would say.
Well, certainly, I believe that God created gold for our use as money. Whether or not one believes in God, you sort of touched on the idea that it has the attributes that have allowed or caused markets to make it money. And I would argue that on the religious side, on the various religions, they probably see it as honest money. So the whole notion of being able to steal or to rob one person from the next. I mean, my goodness, what is inflation? What is fiat money other than a reallocation of wealth?
Yeah.
by those who create the process, and they punish and hurt the people that actually create the wealth in many cases. The farmers, the manufacturers, the miners, the inventors, those people don't necessarily, I mean, I'm in the mining industry, and I see the mining engineers and the geologists are not necessarily wealthy people most of the time. Sometimes there are exceptions. But the bankers, the guys that create the money, the guys that are able to lend the money or raise capital for those are the guys that drive around, have the yachts in the harbor in Vancouver, it seems to me. And so I'm just thinking that maybe that would be very interesting. I would look forward to your insights next year on that sort of spiritual element of, probably the monotheistic religions at least, and how why gold fits into their picture. But anyway, let's talk a little bit about, you identify yourself as an Austrian economist. How did you come about to subscribe to that school of thought? Because, of course, it's not in vogue. We're all being, the propaganda that we get in the universities, I think it's true in Europe as well as in the U.S., is all Keynesian still, isn't it? Or are you seeing some evidence of free market economics being taught in Europe?
Not really, unfortunately. There are some universities that teach Austrian economics, but over here in Austria, where I was born and raised in Vienna, which is basically which used to be the center of Austrian economics, with Ludwig von Mises, Karl Menger, Eugen Böhm-Bawerk, and Hayek, of course. It is not taught at all, and I can see I'm doing presentations quite frequently, and every time I go to Eastern Europe, to Czech Republic, to Poland, and so on, I can see that people, and especially young people there, are much more open to those libertarian ideas. Yeah, right. They have read their Mises, they have read their Hayek. They follow the current advocates of the Austrian school because they know how socialism feels, and they want to do everything to avoid having socialism again. While I would say in Western Europe, we're having welfare states that are of course based on huge piles of debt, but so far everything is going fine. So there is no need to really discuss or teach other schools of economic thought. For me, the whole process was, I was sitting in a bank, and in 2008, everything was crashing down, and I read a brilliant quote by Ludwig von Mises, and I've never heard about Ludwig von Mises before, unfortunately, because we're not teaching Austrian economics, unfortunately. And then I read up everything about Ludwig von Mises and started reading about the Austrian school, ordered like a dozen of different books on Austrian economics. And I basically swallowed the red pill. And from then on, I understood many things completely differently than, I would say, the mainstream, and especially the economic mainstream. But I think Austrian economics is not only about the economy. It's very much about history. It's about society. It's about politics, about just human beings being in the center of the thought process. And then at some point, of course, I thought, okay, I feel like the vegetarian in the big butchery. So I had to quit my job and set up my own company. And we set it up in Liechtenstein because it's probably one of the best jurisdictions in Europe, with the Liechtenstein family that is very much familiar with the Austrian School of Economics. They also wrote a foreword for our book. That was kind of my history. And I think that at the moment there's interest in Austrian economics is becoming a bit less. But I'm absolutely certain that with the next crisis, and it might be around the corner, I think there will be a huge additional demand and interest in the thoughts of Austrian economics again. And we try to do our best to educate people about our monetary system, the consequences of our monetary system, the Cantillon effect, for example, and we try to implement those Austrian ideas in our investment process.
Well, indeed you do, and it's easy to understand how people aren't open to Austrian economics. You go to the university. I think the Federal Reserve has 300 economists, and I doubt that there may not even be any of those guys that have ever read von Mises, or girls, as the case may be. So, and you're certainly not going to get a good grade if in your final exam you start espousing von Mises rather than Keynes, I suspect. So, certainly the reward from the system is there for people who continue to follow the herd, right, and follow the lemmings, as it were. But I want to ask you, looking at a copy of your 2017 In Gold We Trust, that the first sentence in the introduction starts out by saying, "We live in an age of advanced monetary surrealism." Can you talk to us a little bit about, I'm sure it's not less surreal now than it was last time. Could you talk a little bit about the surreal nature of our monetary system right now, and also then what the repercussions of this system are, both in terms of the economy, what we might be looking towards in the near term and longer term?
Yeah, of course. Well, of course, we are highly critical of interventionism, especially monetary interventionism, and we have seen that. First of all, I think that there's the most important price in our economy is the interest rate, and I think it's completely nonsensical, especially if you study history and the histories of booms and busts. It is completely obvious that central banks are mostly reliable for those boom and bust cycles that are getting worse and worse from every bust to bust. Now, we have seen as the reaction to the 2008 crisis, central banks all over the globe significantly lowered interest rates. We had, I think, 700 steps to lower rates. Some of them are already in negative territory. One thing where every human being that has got some sense of economic understanding would say, okay, negative interest rates, that just cannot work. We have seen quantitative easing all over the globe. So central banks created $20 trillion out of thin air. And of course, this had consequences for market prices. Of course, if you look at stock charts and the correlation to central bank balance sheets, it is a very high correlation.
Yes.
We're seeing this asset price inflation not only in the stock market, but especially in the bond market. We're seeing it in real estate all over the globe. We're seeing it in the art market, ridiculously priced assets all over the world. And this is a consequence of the environment that central banks created with their extreme policy. Now, 2018, and this is one of the major points that we're making in our new In Gold We Trust report, 2018, this liquidity party that we had for 10 years is ending. The Federal Reserve started the QT program, so they will reduce their balance sheet by 420 billion this year, 600 billion the next year, and 600 billion the year after. This is quite a lot of money, and it's not only the Federal Reserve, it's also the Bank of Japan, the National Bank in Switzerland, of course the ECB, that are very slowly and with a big time lag becoming more hawkish. They reduce their quantitative easing. They kind of start communicating about rate hikes and so on. So this liquidity party is definitely ending, and this will have massive consequences for asset prices. Now the big question for me is, what will central bankers do if the next recession is coming up? And I'm already seeing a recession on the horizon, because normally central bankers lower interest rates by 500 basis points in the course of a recession. If they're going to do it that way again this time for the next recession, we are in deeply negative interest rate territory, and this will obviously destroy the whole banking system. So a recession is a very, very important topic that we're writing quite a lot about in the moment. We think that this cycle is massively influenced by interest rate policy, and the Federal Reserve already did 6 rate hikes, and of course with some sort of a time lag, this has consequences, and we're seeing them already in the housing market that seems to have peaked. We're seeing them in the credit market and so on. So from my point of view, recession will happen probably in 2019.
Okay, Ronnie, we're going to have to leave it go at that because we're just about out of time. I guess 30 seconds, if you could tell us, what do you think in terms of the impact on gold, if you can be very quick with it, and we'll get you back again to discuss more detail.
Yeah, of course. Well, normally recessions are a great environment for gold because gold anticipates lower rates. Gold anticipates that there is volatility in markets. Money is flowing out of the equity markets and seeking for a safe haven. And from my point of view, this time the safe haven won't be bonds. It will mostly be physical gold, and that's from a contrarian point of view, it's a great setup, and I'm pretty relaxed about the gold price.
Okay.
and yeah,
we'll have to leave it go at that, Ronnie, because we're out of time, unfortunately. But I do want to have you back so we can talk in more detail about some of these issues.
Absolutely.